This is Clear Path Retirement Radio. I am Stewart Smith here with Mitch Davies. So, some of the things that I want to talk about here in this segment is one of the things that we see, and we're just talking tax efficiency right now, and one of the things that we've talked about with folks recently, and I want to bring up is, this whole qualified charitable donation thing. It surprises me that more people don't understand this or are missing the boat on this. So I just want to mention it today on the show. Once you get to be age 70 and a half, and you are charitably inclined, and that means you are giving money to a church, you're giving money to any 503c nonprofit, any charitable activity that you have in your life, and we're in the South, so a lot of people are charitably inclined, and most people are tithing to their church. You need to make sure that when you get to age 70 and a half, that you change how you are making those charitable contributions. Most people are giving the church money on a weekly basis. Most people are just giving them money, and then at the end of the year, they might be claiming a charitable deduction on their taxes. Once you get to age 70 and a half, you are allowed to do what's called a qualified charitable donation, and that is where you are able to give money directly from your IRA or pre-tax account to the charity. And as long as it doesn't go through your hands first and it goes directly from your IRA to the charity, that money comes directly off the top. It's not a charitable deduction. It comes directly off the top of your taxable income, just like a standard deduction would. And it is a much more tax efficient way to be giving money to your church. And you need to understand that. And if you're not doing that, then please give us a call at 864-775-5033 or go to clearpathretirement.com and let us know that you want to sit down, and let's get that set up to where you are doing that directly from your IRA. You can still do it with most custodians. Most places that hold the money will still allow you to do it on a monthly basis. Maybe at worst case, it would be just on an annual basis, but you do the same amount you would have done for the whole year. You just do it at once. And most churches are not going to mind that whatsoever. And they can work that into their cash flow and their planning and how they do things. But trust me, that is one of the things we see people miss the most.
All the time. And we'll see people who we'll talk about Roth conversions. And they're like, no, I'm doing Roth conversions, right? Like, I'm trying to get it all done. Everybody wants to try to get money converted before they turn 73. Because at 73, you have to start taking those required distributions where you have to take the money out and pay the taxes, right? And so people will be doing Roth conversions, and we'll ask about qualified charitable donations, and they're like, no, I don't. So if you're doing Roth conversions, if you're trying to get that pre-tax money out, which is a lot of times our goal, the QCD, the qualified charitable deduction, is a really good way to just add a little bit more to that, right? Knock down that income. Just like when you're working and you contribute to a 401k, comes right off the top of that income before the standard deduction. So it's stronger than taking an after-tax deduction on that money.
And it counts towards your RMD.
Yep.
Like, a lot of people miss that. Like, right. This counts towards your RMD. So that is money that counts towards your required minimum distribution, the money you have to take, and also comes right off the top.
Yeah, it's a double tax benefit.
It's so good, right? Yeah. And you can do up to $108,000 a year out of your IRA through qualified charitable donations. And since it reduces your taxable income, it could keep you from hitting thresholds that you're hitting. It could keep you from hitting IRMAA thresholds, or it could keep you from, hitting the threshold for the extra deduction on the One Big Beautiful Bill Act.
Right.
And that's just smart planning, guys.
Yeah.
Like, that's just, you need to understand that. That is probably the best kept secret that there is out there. And, the other thing I want to put on your radar is through 2028, you're getting that extra standard deduction for a married couple of $12,000 a year on top of the already great standard deduction of what, $31,500 that married couples get in this country. And, what a better time what better time would you have to be thinking about doing some small Roth conversions than while you're getting these extra, standard deductions? That's, $12,000 a year of money that you could be converting really at no extra cost to you. And, that is something that, if you've thought about doing them, you're confused, you're not sure about the Roth conversions. I mean, starting there would just make perfect sense. And so, a lot of people are like already required minimum distribution age, and they're worried about, well, how does that affect my required minimum distribution? Well, you just have to take your RMD first. Right. And then once you've taken that, you can convert in addition to what your required minimum distribution is. And, you can still do it. It's still very doable, and it's still going to help you tremendously in the long run. When you do Roth conversions, you got to be thinking long term. Right. You got to really be thinking over about 25, 30 years about the benefits in that. And if that's something you've been thinking about, you're not sure about, give us a call, 864-775-5033. Or go to clearpathretirement.com and just hit that Get Started button now and just send us a message. Let us know, hey, this is something I've been thinking about. Can you guys help me get clear on this? And we'd be happy just to sit down and have a discussion. No pressure, no obligation to you whatsoever. Guys, we will be right back for our last segment.